Everyone assumes the tax break you get today is the better deal, but what if the government is just letting you borrow rope to hang yourself with later? Welcome to one of the most quietly consequential debates in personal finance: tax-deferred versus tax-free accounts, and why getting this wrong could cost you tens of thousands of dollars in retirement. We're talking about the difference between a traditional 401k and a Roth IRA, two accounts that look almost identical on the surface, but function like completely different animals when the tax bill finally arrives. One lets you skip taxes now and pay later. The other makes you pay now so you never have to think about it again. Here's the thing though, for decades, the conventional wisdom was dead simple: defer, 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 because you'll be in a lower tax bracket in retirement anyway. That assumption made sense in 1985 when top marginal rates were crashing down and everyone believed taxes would only go lower from there. But then something funny happened. Tax rates stopped falling. National debt climbed past $33 trillion. And suddenly that "you'll pay less later" promise started sounding a little optimistic. It's like running up a tab at a restaurant, assuming the prices will be cheaper when the check arrives, except the chef just announced he's remodeling. The behavioral economics angle here is genuinely fascinating because humans are wired to prefer immediate rewards over future pain. It's called hyperbolic discounting, and it's exactly why tax-deferred accounts feel so seductive. You see a bigger paycheck today, your brain celebrates, and the future tax liability gets filed under future use problem. But here's where history gets humbling. Look back at the 1974 ERISA era when tax-deferred accounts were invented, and nobody was modeling what a 30-year accumulation of deferred taxes would look like at forced withdrawal through required minimum distributions. Retirees today are discovering that their nest egg comes with a mandatory annual tax event, whether the market cooperates or not. The irony is almost poetic. You spend 40 years congratulating yourself on being disciplined, only to find out the IRS has been a silent partner in your retirement account the whole time, patiently waiting for their cut to compound right alongside yours. Financial planner Michael Kitces has called this the tax time bomb. And that phrase alone should make you pause before defaulting to whichever account your HR department set up on autopilot. Now, to be fair, tax-deferred accounts absolutely win in specific scenarios if you're in a high tax bracket today and you genuinely expect to be in a lower one in retirement. Deferring is mathematically correct. The mistake isn't using traditional accounts. The mistake is assuming that one size fits all without ever running the numbers. The common misconception worth addressing head on is that Roth accounts are only for young people or only worth it if you're in a low bracket now. That's an oversimplification that ignores tax, diversification, Roth conversion ladders, and the fact that tax-free growth on 30 or 40 years of compounding is a genuinely powerful asymmetric bet. You're not just betting on your future bracket, you're betting on the entire political future of the tax code, and that is a very wide range of outcomes. The practical lesson history keeps teaching is this: don't put all your eggs in one tax basket. A blend of tax-deferred, tax-free, and even taxable accounts gives you optionality, the ability to pull from whichever bucket is most efficient in any given retirement year, and optionality in an uncertain tax environment is worth real money. Disciplined strategy here means running a simple projection at least once, model your expected income in retirement, factor in Social Security, pensions, and required minimum distributions, and see what bracket you actually land in. If the math says you'll be pushed into the 22 or 24% bracket anyway, that deferred tax benefit starts looking a lot thinner. The philosophical truth underneath all of this is that neither account is universally superior. What matters is that you made a deliberate, informed choice rather than sleepwalking into the default option. Discipline, sizing across account types, and consistency of contribution beat conviction about any single tax strategy every single time. You don't need to predict the future of the tax code. You need to build a portfolio that's resilient across multiple futures. And that's actually a freeing realization once it clicks. Whether taxes go up, down, or sideways. A diversified tax strategy means you're never entirely wrong. If you take nothing else from this, take the reminder that the best financial plan is the one you actually execute, with consistent contributions, rational rebalancing, and zero panic, not the one you theoretically optimize for a tax scenario that may never materialize. The account type is a detail. The behavior is the whole game. And if you want help building a strategy that actually works for your specific situation, whether that's real estate investing, home contracting, work, or finding the right lenders, check out our links in the description below.